AM Best rated Bermuda, Cayman Islands, and Barbados captive insurance companies continue to outperform their U.S. commercial casualty peers, with potential for further growth given market conditions. I'm Lori Tortis for AM Best TV. Here to discuss a new report on the segment is Robert Gabriel, a financial analyst at AM Best. Robert, welcome. Thanks so much for joining us today.
Sure. Thanks for having me, Lori.
Robert, how is the hard market impacting Bermuda, Cayman, and Barbados captives?
Sure. So the current hard market has helped fuel a lot of the captive growth that we saw in 2021 in Bermuda, the Cayman Islands, and Barbados. With the current commercial market conditions exhibiting very dramatic premium rate increases year after year, we're seeing reduced capacity and more restrictive coverage terms. It certainly makes a lot of sense that there's renewed interest in captives right now. Captives are well known for being able to provide their owners with greater flexibility and more control in managing their risks. And a couple examples of this could be through their ability to offer more tailored and customizable coverages that their owners may not otherwise be able to obtain in the traditional market right now. Also, captives allow for better stabilization of premium costs, which do allow their owners to counter some of the price volatility that they're seeing in the traditional market. So I think all those captive attributes make them very attractive alternatives right now in the hard market.
How does the performance of this captive segment compare with their peers in the commercial lines segment?
So the story here remains largely unchanged for the most part. We've grown accustomed to seeing the captive industry as a whole, both domestically here in the U.S. and internationally, continue to outperform their peers on the commercial casualty side by a fairly wide margin too. But in looking at the BCIB captive industry specifically, when we compare the combined ratios of the two segments, the BCIB's 5-year average combined ratio of an 86 is about 13 points lower than that of their peers on the commercial casualty side. So this just speaks to the higher level of underwriting profitability that we're seeing with captives. And this is important when we think about a captive's underwriting profits because, captives' underwriting profits can also be viewed as insurance expense savings that their owners would otherwise be passing on to the traditional commercial market. So with the higher levels of underwriting profitability, it's truly a win-win situation for a lot of the captive owners in the industry today.
What is it about the captive industry that allows it to, year after year, outstrip its commercial counterparts?
So I think a major part of it comes down to expenses. Typically, captives by design have very limited overhead cost structures, which is very beneficial to them. And then they also have significantly lower net acquisition costs as well. Pure captives are created to insure the risks of their parent companies. So essentially all the business that they write is done so on a direct basis, which means they usually end up paying a lot less out in commissions each year, and generally have fewer costs related to acquiring their premium relative to traditional insurers. And then also on the loss side, captives continue to report favorable loss results year after year. And I think that's just a result of captives being very well embedded into the organizations that they cover and insure. I think when a company or a business decides to form a captive for itself, that organization over time tends to develop much stronger risk management and loss control processes, which is just a natural result of them being in the business of retaining their own risks and providing coverage for their own losses. And then finally, just related to claims, captives do allow for greater control over the claims handling process. So when potentially large claims do arise, they could be identified a lot sooner and handled and settled earlier on, which can help reduce costs as, incurred losses do tend to increase the longer they stay open for certain claims. So when you factor in all those inherent benefits that I just laid out, I think those are the reasons why we continue to see the captive industry outperform their counterparts on the commercial casualty side.
Robert, thank you so much for speaking with us today.
Sure. Thank you, Lori.
That was AM Best financial analyst Robert Gabriel. For AM Best TV, I'm Lori Tortis.